They told you 2008 was a once-in-a-lifetime anomaly. They lied. The greatest housing correction in history isn't looming in the future. It began in the silence of late 2022. While the mainstream media celebrates nominal record highs, the underlying data screams a terrifying reality. Inventory in the Sun Belt is exploding to levels unseen since the Great Recession. Real asset values are being quietly eroded by inflation, and a winner's curse is currently trapping millions of buyers in debt they will never recover. I have spent years tracking a lost 200-year-old economic formula, a code hidden in plain sight since the 19th century that has predicted every single major market collapse with terrifying accuracy. It doesn't just tell us if a crash is coming, it calculates the exact date the carnage ends. The clock is ticking toward a singular mathematical point of reckoning, February 2027. But understanding that date is only half the battle. What happens to your money between now and then will decide if you survive the transfer of wealth that is already underway. If you believe the narrative that the housing market is resilient, you are looking at the past, not the present. The comfortable illusion that 2008 was a singular, non-repeatable catastrophe is currently being dismantled by the data, month by agonizing month. While the mainstream headlines focus on nominal highs, the structural integrity of the U.S. housing market began to fracture 3 years ago in late 2022. We are not approaching a cliff. We are already sliding down the face of it. The only difference is the speed. To understand the magnitude of this invisible crash, we must first strip away the noise and look at the raw inventory data. In a healthy market, supply and demand exist in a delicate stasis. Today, that stasis is gone. We are witnessing a surge in inventory that we haven't seen since 2019, right before the global economic anomaly of the pandemic. But the composition of this inventory is toxic. It is not just fresh homes entering the market. It is the accumulation of stale listings, homes that have sat unwanted for over 60 days rotting on the vine because sellers refuse to accept the new reality. The media loves to throw around terrifying numbers to grab your attention. Headlines screaming that markets like Arizona are down 40% or Florida has crashed by 30%. These numbers are technically derived from data, but they are often misinterpreted, leading to a dangerous misunderstanding of the actual financial risk. Let's clarify the forensic reality. When you hear Arizona is down 40%, you are looking at the percentage of active listings that have been forced to cut their asking prices. In Phoenix, for example, a staggering 31.3% of sellers have had to slash their prices just to get a showing. This is a sign of desperation, yes, but the actual transactional value, the money changing hands, has dropped by a more modest yet structurally significant 6.9% to 10% from the peak. This distinction is critical. We aren't seeing a sudden, violent 40% evaporation of wealth overnight. Instead, we are witnessing a slow grind, a painful extended period where the market suffocates under the weight of its own excess. In Austin, Texas, the correction is undeniable and severe, with values plummeting nearly 21.4% from their peak, driven by a glut of new construction that no one can afford to buy. In Florida, specifically the condo market, we are seeing inventory double in areas like Punta Gorda as insurance costs skyrocket, trapping owners in assets they can neither afford to keep nor sell without taking a massive loss. But why is this happening now? Why, after a decade of prosperity, is the ground shifting beneath our feet? The answer lies in a mechanism that has been operating in the shadows for over 2 centuries. To predict the future, we must consult the lost formula discovered by economist Fred Harrison, a cycle so precise it has predicted every major housing crisis for the last 200 years. This isn't astrology, it is the economic heartbeat of land speculation. The market moves in a rigid 18-year rhythm. It begins with 7 years of slow recovery, followed by a mid-cycle dip. Then comes the second phase, 7 years of explosive, speculative growth. Finally, it ends in a 4-year phase of devastation. This formula predicted the Great Depression. It predicted the 2008 financial crisis, and it dictates exactly where we stand today. We are currently in year 14 of this cycle. The frantic peak of 2022 marked the technical top of the explosive growth phase, but here is where the trap is set. According to the most recent analysis of Harrison's model, the years 2025 and 2026 do not represent a recovery. They represent the winner's curse. This is the treacherous final gasp of the cycle where prices may hover near highs, and amateur investors, driven by the fear of missing out, rush in to buy at the absolute top. The opponents of this theory will point to the fact that the Federal Reserve has cut rates, or that nominal prices are holding steady in the Northeast, as proof that the crash is canceled. They are wrong. The 18-year cycle is not driven by the Fed. It is driven by the limits of human affordability and the eventual exhaustion of credit. The history of this cycle tells us that when we pass year 14, the probability of a soft landing drops to zero. We are watching a system that has run out of time. The crash that began in late 2022 was merely the opening tremor. The actual fracture, the moment the floor falls out, is mathematically scheduled to accelerate as we move toward the final phase of the cycle. And unlike 2008, where the damage was obvious, this time the danger is masked by inflation and a lack of liquidity. Sellers are delisting their homes at record rates. 6% of listings are vanishing every month, not because they sold, but because owners gave up. This shadow inventory is a dam holding back a flood. So if the cycle holds true, as it has for 2 centuries, we can calculate the trajectory. We know the destination. But to pinpoint the exact month of the bottom, we need more than just a timeline. We need to analyze the second factor, the brutal reality of price mechanics. To find the bottom, we must first understand the architecture of the top. The prevailing theory, one that many desperate analysts are currently clinging to, is known as the triple peak pattern. It is a technical formation that has appeared before every major financial disaster, from the interest rate shocks of the 1980s to the precipice of 2008. The pattern is simple, yet seductive. Since the primary peak in June of 2022, the market attempts to rally, fails, and establishes a lower high, creating a descending staircase of value that leads inevitably to the basement. The opponents of our thesis argue that this pattern is already visible, that since 2022, we have seen 3 distinct peaks, each weaker than the last. They claim home prices are already down 9% from the true peak, and have another 9% to fall to return to historical norms. But if you look closely at the data from late 2025, a more complex and sinister reality emerges. We are not just seeing a simple staircase down, we are witnessing an optical illusion caused by the destruction of the currency itself. While the triple peak pattern suggests a market losing momentum, which is true, nominal home prices in many regions actually hit new all-time highs in 2023 and 2024. This contradicts the narrative of a simple linear crash, but do not mistake this for strength. This is the definition of stagflationary decay. When you adjust these record high home prices for inflation, which has run rampant above 3%, the real value of residential real estate has been eroding for 3 straight years. The asset isn't gaining value. The money you are using to buy it is dying. You are not investing. You are merely parking capital in a depreciating vessel to hide it from inflation. This decay is not uniform. If you want to see what the future holds for the rest of the country, you must look at the correction zones, where the illusion has already shattered. Look at Austin, Texas. This was the poster child of the pandemic boom, the city where everyone moved. Today, it is the epicenter of the bust. Prices in Austin haven't just corrected, they have collapsed by nearly 21.4% from their peak. This is not a soft landing. This is a violent repricing driven by a supply glut that overwhelmed demand. The inventory there didn't just grow, it exploded, forcing a market reset that has wiped out equity for anyone who bought during the euphoria of 2022. Then turn your eyes to Florida. The narrative there is different, but the outcome is the same. The opponent's script mentions a 30% drop, but the reality is far more specific and terrifying. We are watching a condo crisis unfold in real time. In coastal areas like Punta Gorda and Cape Coral, inventory has doubled year over year. Why? Because of a structural failure in the insurance and maintenance markets, with insurance premiums tripling and new laws forcing massive reserve funds for repairs. The cost of holding these properties has become mathematically impossible for the middle class. Owners are fleeing, not because they want to sell, but because they can no longer afford to own. This brings us to the most dangerous misconception in the current market: the belief that you should wait for interest rates to drop. The Federal Reserve recently cut short-term rates, yet mortgage rates moved higher. This baffled the uneducated observer, but it is textbook economics. Mortgage rates track the 10-year Treasury yield, which moves based on inflation expectations and investor fear, not the Fed's short-term policy. Here is the trap. You might think high rates are the problem. You might be waiting for them to fall to 5% or 4% before you buy. But as the 18-year cycle enters its winner's curse phase in 2026, falling rates would actually be the catalyst for the final disaster. If rates drop too fast, the millions of buyers currently sitting on the sidelines will flood back into the market. We are currently in a lock-in environment. Homeowners with 3% mortgages refuse to sell, creating an artificial shortage that props up prices. If rates drop, that inventory unlocks, but so does the pent-up demand. The result would be a momentary, violent spike in competition, a melt-up, before the sheer lack of affordability crushes the system entirely. So we have established the time. We are in the 14th year, the phase of the winner's curse. We have established the price action, a nominal plateau masking a real value collapse led by the catastrophic corrections in the Sun Belt. But to solve the equation and find the exact date of the bottom, we need the third and final variable. It is the one factor that no amount of government intervention or creative accounting can hide. It is the hard ceiling that dictates exactly how much a human being can pay for shelter. It is the affordability wall, and we have just crashed into it at full speed. Markets can remain irrational longer than you can remain solvent, but they cannot remain irrational forever. Eventually, every speculative mania crashes into the same immovable object, the paycheck of the average worker. This brings us to the third and most critical factor in our equation for the bottom: income. There is a specific mathematical relationship that dictates the health of a housing market. It is the price-to-income ratio. For decades, in a functioning economy, this ratio sits comfortably at 3.5. That is the golden number. It means the average house costs 3.5 times the average annual salary. At this level, families can buy homes, banks can lend safely, and the velocity of money remains stable. But today, that stability is a distant memory. We have severed the link between labor and shelter. According to the most recent data from late 2025, the price-to-income ratio in the United States stands at a suffocating 5.1 times. This is not just expensive, this is a structural failure. We are deviating so far from the historical mean that the market is no longer functioning for the people it was built to serve. Let's translate that ratio into the brutal reality of your bank account. To purchase the median-priced home in America right now, not a mansion, just a standard roof over your head, a household requires an annual income of approximately $110,000. Yet the actual median household income is languishing at roughly $83,000. Do the math. There is a $27,000 gap between reality and fantasy. This gap represents millions of Americans, teachers, nurses, engineers who have been mathematically eliminated from the American dream. They are not waiting on the sidelines. They have been evicted from the game entirely. The last time we saw a correction of this magnitude was the bottom of the 2008 crash in 2009. Back then, the bleeding didn't stop until the price-to-income ratio fell all the way back to 3.7. That was the signal that the carnage was over. That was the bottom. Today at 5.1, we are miles above that safety zone. We are suspended in thin air, held up only by the lack of inventory and the stubbornness of sellers who refuse to accept that their homes are not worth what Zillow says they are. This affordability crisis is the silent killer of the housing market. It acts like gravity. You can fight it for a while with mortgage buy-downs and creative financing, but eventually gravity wins. For the market to reset to that healthy 3.5 ratio, one of two things must happen. Either incomes must explode upwards by 40%, which in a slowing economy is impossible, or home prices must come down, and they must come down significantly. We are seeing the early stages of this forced realignment. The opponent's theory suggests that because the ratio has dropped from a peak of 5.8 down to roughly 5, we are on the right path. But this is a slow grind, a torture by degrees. The gap between what sellers ask and what buyers can pay is paralyzing the system. This paralysis is why transaction volumes have hit record lows, even lower than 2008. The affordability wall is the reason why the winner's curse of 2026 is so dangerous. Any slight increase in prices from here doesn't represent value. It represents a deeper detachment from reality. We have reached the ceiling. The market cannot go higher because the money simply isn't there. So we have our three variables locked in. 1. Time. The 18-year cycle places us in the final volatile winner's curse phase before the 2027 turning point. 2. Price. The triple peak illusion is fracturing with real values falling in correction zones like Austin and Florida leading the descent. 3. Income. The 5.1 ratio proves we are mathematically required to fall much further to reach the 3.7 bottom. Now we take these three oppressive realities and put them into the formula. We can finally answer the question that haunts every prospective homebuyer. When does the pain end? When is the exact moment the knife stops falling? We have now assembled the three critical components of the machine: the 18-year cycle, which governs the timeline, the triple peak pattern, which tracks the erosion of price, and the price-to-income ratio, which defines the limit of human affordability. When we feed these variables into the algorithm, the output is not a vague prediction. It is a precise coordinate in time. To calculate the absolute bottom, we must determine exactly how much further prices need to fall to intersect with the historical trend line of 2.6% annual appreciation. The data indicates we are still overpriced by approximately $37,000 per median home. Next, we calculate the velocity of the crash. The current accelerated decline rate is burning through equity at a pace of roughly $2,100 per month. The math is brutally simple. You take the remaining drop of $37,000 and divide it by the monthly decline of $2,100. The result is exactly 16 months. If we anchor this calculation to the late 2025 inflection point, counting forward 16 months lands us on a singular definitive date, February 2027. This date is not a coincidence, it is the convergence of all economic forces. First, it marks the mathematical completion of the 18-year cycle. Second, it allows the price-to-income ratio to reset to the acceptable level of roughly 3.7 times, mirroring the exact conditions of the 2009 bottom. Third, February is historically the weakest month for housing liquidity, creating the perfect storm for a final capitulation event, exactly as we saw in the last crisis. February 2027 is the date the knife hits the floor. That is when the bloodletting stops and the new cycle begins. But you do not have the luxury of simply waiting for 2027. The market is fracturing now, and waiting carries its own risks. If you need to act before this terminal date, you must use the bubble formula to protect your capital from the remaining decline. The strategy is aggressive and non-negotiable. If you are buying in a standard national market, you must force the correction immediately. Take the current asking price and slash it by 10%. If a home is listed for $500,000, your ceiling is $450,000. Do not pay a penny more. However, if you are operating in the bubble markets, specifically states like Texas or Florida, where prices hyperinflated by more than 40% during the pandemic, the danger is magnified. In these zones, a 10% discount is suicide. You must demand a discount of 20% to 25% below the asking price. I recently applied this exact formula to a property listed at $600,000 that had been rotting on the market. By leveraging the data, we forced the price down to $500,000. This isn't bargaining. It is a correction of value to reflect the reality that sellers are trying to ignore. The system is resetting. The 18-year clock is ticking down its final months. You now possess the date. You possess the formula. The only variable remaining is whether you will be a victim of the crash or the one who capitalizes on the rubble. February 2027 is coming. Prepare accordingly.